Hello, everybody, and welcome back to Virtual Battles, episode 3, which is a YouTube channel on quantitative commodity trading. As a reminder, in the first couple of episodes, we set the stage, we introduce who is who in the oil market, we identify winners and losers, we identify that the winners tend to be fast-moving hedge funds. Then we explain on a high level the mental models, how they work. And in this episode, we continue on the same theme, but we're going to ramp up a little bit more quantitative analysis, and we'll try to replicate their behavior. We'll try to show actually how we can reconstruct of what they do. Importantly, and not to forget, the entire channel and this presentation is for educational purposes only. By no means it's any financial advice. So it's all based on my book and a lot of other publications. It's all in public domain. So let's continue. And one of the operational things, so I'd like to highlight that the vision for that channel is really to continue on certain topics that I raise in my book, but also to build new stuff. And I can't build it all myself. I welcome participation of others, and I work a lot with different partners. So the work that I'm going to present today is not actually in the book. It's briefly mentioned there, but this work was developed and published and co-authored with Woo-Yen Sun, Jonathan Sun, who is a research fellow with CAPSARC, which is the largest petroleum think tank in Saudi Arabia. That's a link to the study. It's very detailed, comprehensive study published a couple of months ago in the summer of 2025. And more recently, a shorter version of this study was published by another partner of mine, Commodity Insight Digest, which is an online publication on commodities. I think it's under the umbrella of Bayer School of Business in London. You can find it. You can find it there, and here is the link. So we're gonna apply today the neural networks. I mean, don't be scared with the term. And so what is a neural network? I'm not going to spend more than 20 seconds on that because you can easily find a lot more better explanation online by Googling it. So it's basically neural network mimics the behavior of a human brain. So roughly they consist, and this is a schematic representation you might have seen in your statistical textbooks already. It has basically 3 layers. It has an input layer, which they call features. Have an output layer on the right, input on the left, and in the middle, they have hidden layers. Could be one, could be multiple, and I'll explain you what they are. So the individual nodes or neurons, they process different type of information from the input layer. Like our human brain gets a lot of different types of information. Then we assign a certain weight to different type of information we receive, and then we act on this information using some nonlinear response function. Could be a binary. For example, your response function could be a listen or not to that YouTube channel, and the information you may get, you may find out that Ilya wrote a book and assign a certain value or weight to that information, which may be high, or you may say, oh, Ilya is retired, he doesn't have any practical current experience, maybe low weight or something like this. And you weight all this information together, and then you make a decision, basically a binary decision, whether to listen to me or not. So that's done by a nonlinear response function or neuron activation function. The idea here, if the actions are observable, that becomes like a behavioral pattern. Then we can reverse engineer the weights that the human brain assigns to certain action by basically comparing inputs and outputs and trying to reverse engineer what's inside our brain. Okay, well, it turns out, and that's the primary idea here, that the behavior of CTAs and or hedge funds, I should say more broadly, collectively, is kind of almost a mathematical definition of a neural network. We can't obviously model individual hedge funds or individual traders because they weigh and process information very differently. But what we'll try to do, and that is really ultimately what matters, we're gonna try to model them on aggregate or collectively what they do. So in this case, we're gonna focus on a subset of funds, specifically on CTAs that we have discussed in detail in episode 2. And as you know, they use a lot of historical prices for their decision making because ultimately they are trying to identify patterns in the historical prices and bet that this pattern is going to repeat and trade based on that information. So in their case, the inputs or the features, which is here on the left, are historical prices. So the individual hedge funds then are basically neurons. And here they are represented with the three circles as neurons. And they are activated, their action is activated by a certain reaction function. And all these informations and all these things interconnected, and all these connections have a certain weight. So we're going to get into that in more detail in a minute. And then ultimately, the results, the output Y is their position. So here's a basic idea. We know the inputs, which are prices. We know the positions, which are reported by CFTC, by COT report. Can we basically reconstruct what's inside? All right, don't be scared. The mathematics here is fairly simple. And again, I'll defer most of the details to the book, or in this case, to the publications. So recall from the previous episode, the winners are fast money, and some of them favor momentum trading signals. So the question again, can we replicate the strategy of the winners? Can we replicate what's inside their brain? So there are many ways, as I explained previously, to define the momentum. We're gonna use a very simple one. We're gonna use a moving average momentum. So the moving average is just the average of n previous prices. So we just average them on time t, use n previous prices, and then the basic momentum signal is the difference between today's price and the moving average. So the trading strategy, as again we discussed last time, based on the sign of it, if today's price exceeds moving average, you buy. If it's below moving average, you sell. That's your basic momentum strategy. In practice, however, the hedge funds are using the crossover of moving averages. And that's simply because there is a lot of noise in the data. You don't want to really react to a single price because it could be essentially based on fake news. So you want to see some kind of confirmation that that's a real momentum. So they rarely really use a basic momentum. Instead, they smooth out the signal. So they may smooth like 3-day prices or 1-week prices. So in this case, the signal would be based on a crossover of moving averages. So one is short term with M look back days, and one longer term with N. For example, you can use 520 crossover moving average momentum. That would be 5, meaning it's 1 week, roughly 5 days a week, and 20 means 1 month. So in other words, if 1 week moving average of prices exceeds 20-day moving average of prices, you buy, and if it drops below, you sell. And again, you can use 1 month versus 6 months or versus 1 year, etc. So this is what they use, but it's actually quite easy to see that the crossover moving average is nothing by the 2 simple momentum signals. And to see that, so MA with M look back periods, you can substitute moving average from the previous formula simply as F minus M day momentum, just substitute it here, then do the same thing for N day moving average. Your current price cancels out. So the crossover of moving average can then be written as the difference between 2 simple momentum strategies. So in my example, 520 momentum, note that the N and M flips here. MN moving average crossover is equal to N, the longer dated simple momentum minus the shorter dated. For example, 520 moving average would be equal to 20-day simple momentum minus 5-day because you're smoothing it over 5 days. Hope I didn't confuse you, but it's not that essential. The reason I did that because that means all the crossover moving averages can be essentially mapped into simple momentum. So all we really need to do, we just can work with simple momentum signals, and that's enough because they essentially encompass all of the more complicated signals. So in this case, schematically, so we started with roughly 250 data points, which represent historical prices over last year, over past year, and then we basically compress them into in this case 25 simple momentum signals, and 25 what I did here. So we used 10-day increments. 10-day, 20-day, 30-day, 40-day, all the way up to 250-day moving averages. So basically, so we shrink the entire daily prices into 25 what we call features. We effectively re-engineered features because we don't want to work with all 250. It's way too many. So we need to find some like a basis that basically has fewer features, just easier to work. And in this case, we're going to use essentially 25 conveniently re-engineered features, with each one representing to a simple momentum strategy with loopbacks going with a 10-day increments. Okay, those are features now. We got 25 basic momentum. Now, we're going to map them into, and again, don't get scared with some of the math. That's the only really algebra I have is on that slide. Well, maybe a little bit on the next, but you should be able still to see the punchline here. So so we're going to show conceptually how to map these features into positions. So essentially, the positions is our target. This is what we're trying to match. We know the positions because it's published by CFTC on these dates from 1 to T. So we have a historical sample of positions published by CFTC, and then we can calculate positions held by Fast funds the same way we did in the previous episode. So our target is mathematically what we call a vector, because basically it's on every day you get a number, which is y, and you got t of those days. So I use bold symbols to represent vector and matrices, and the regular font for scalars. So you got t days here, so you have basically a vector of historical positions. And we also normalize that by subtracting mean and dividing by standard deviation. That's mostly to gain some computational efficiency, to eliminate some trend and historical data. That's a fairly standard practice. And then our features, in this case, for every day, so for every day, say x1 is for day t1, so you have 25 momentums. You have 25 momentums that represent historical prices on day 1. So you have a vector here. So each row is a vector here. On day 2, you got a new vector of momentum, etc. On day 3 and on day T, you got a new vector of momentum because you keep moving through the history. On every day, you got 25 momentum signals that represent the history available prior to that day. So you got a matrix here. So that's a target matrix. It's a T by 25 matrix. And by the way, we have more details on that in the paper. Those numbers are also scaled because they don't have the same variance. For longer term, the momentums with longer term look back periods generally have a much higher variance because you're comparing today's price with 1 year moving average versus, for example, comparing today's price with 5-day moving average or 10-day moving average. So the latter is a lot less volatile. To kind of bring them all onto the same volatility scale, we normalize by square root of n. Then in that case, their variance is on the same footing. So the goal is here. So Y is the positions held by the winners in the futures game. X is the historical prices, which we represent by 25 momentum indicators on each day. And we want to reconstruct that function. So we want to find a function that basically approximately maps X into Y. That's really our goal. So going back to my schematic representation of a neural network. So we have 25 features now, re-engineered features, which are momentum. They have all kind of connections, and we have 3 neurons, which basically represents 3 different type of hedge fund. Conceptually, you can think about them as like a short-term fund, medium-term, and longer-term fund. That's the idea sort of behind 3. And we only use a single hidden layer. We'll talk a little bit more about more complex neural networks later, but this is basically each neuron receives information from different momentum signals. Then each neuron assigns weights, W's, to each piece of information. Remember, we have 25 pieces of information. So each neuron has 25 weights, and we have 3 of them. So we have 75 connections total in that representation. And then the action is being triggered by the reaction function, which is nonlinear function, as an example I gave you, whether to listen to me today or not. So in the reaction function I use, it's described in the book. I kind of like this one in particular, and I know some other folks are using it too. One of the reasons I like it, because it actually keep growing. So it's, first of all, it's normalized. So in this case, and I talked about it last time in the last video. So when the strength of momentum is 1, roughly 1 sigma too strong, you have your maximum position. And beyond that, you actually start decreasing your position, because if momentum is too strong in either direction, so the likelihood of the market correction increases. So you want to decrease your position. So in a sense, that reaction function captures a certain mean reverting behavior on the extreme. Or since we are modeling everything on aggregate, it kind of captures a certain type of funds that only buy in low and sell in high. So they would be represented here on the tails of that reaction function. So that nonlinearity is actually quite crucial. So we apply the same reaction function for simplicity to all of these 3 neurons. So we have, and then we weight them with outgoing weights. So we weight the strength of each neuron, because we don't know yet which of these 3 is more or less relevant. So, and this weighted average response gives us the aggregate position. So we have 3 times 25, we have 75 incoming weights, and we have 3 outgoing weights for the total of 78, which we now gonna train. So what we're gonna do, we're gonna find these weights in such a way that our estimate using our model matches the actual observed data as close as possible. So how do we do this training, or it's actually optimization? Again, as I said, so we have essentially a vector of weights. So we have 75 incoming weights, 25 for each of the neurons. So they are represented here as a vector, 25 rows in each. And then we have 3 scalars, which are outgoing weights. So we're gonna determine these weights by minimizing the cost function. So this is a standard cost function that you have seen in many statistical optimization. However, we also add a penalty function. This is called a lasso regularization, a very popular thing to do. And the reason for that is when different features contain similar information, for example, 150-day momentum may have a very similar information to 140 or 170-day momentum. So we don't really need to use all of them. And what this penalty does, it really eliminates essentially unnecessary features. So it identifies a certain number of features that you basically cannot eliminate. So this algorithm is a very popular in trading. It's very easy to implement. So it's being used frequently for different what we call feature selection processes. And that's what we use as well. The details are in the paper, how we choose the parameters, how we do stochastic gradient descent. We use a technique called backpropagation and something called Adams optimizer. So look at this. It's not really essential to get the point. This is the result. So it's showing you the actual positions as in the data on the left and our predicted or approximated position. Quite highly correlated. We got R squared about 56, so which is reasonable. Basically, it says we can explain approximately half of the variance of hedge fund position using historical prices. So we can't explain the other half. We can't explain everything. But in using this very simple algorithm, remember, we only use one hidden layer, only 3 funds, just to illustrate the point. Of course, you can construct more complicated neural networks. You can create multiple hidden layers. In fact, you can kind of think about second hidden layer would be a fund of fund, because there's a lot of fund of fund now allocating money to individual funds. So that would be like a second hidden layer. You can also, and I'll talk about a bit about it at the end, talk about adding other non-price features as well. You can do all of that, but the point of this video and the paper just to give you the blueprint. I know you can construct more complicated neural networks and probably improve the feed. I'll let you do that as a homework. One thing I wanted to highlight also, there's some valuable information that you can obtain by looking at these weights. Remember, there are 75 of them. So, and this is a graph on the left that shows these weights. A lot of them you see as 0 because we use this lasso regularization. So it essentially zeroed out the historical momentum signals which the algorithm found to be irrelevant. So it only found the one that's most important one. So here we have those 25 weights for each of the 3 neurons. They are incoming weights. In the upper right corner, we have outgoing weights on W1, W2, W3. In this case, you can see kind of all of them. So you see the first one, which is in blue, it really favors this one big data point that corresponds to n equals to 30. So it clearly favors a simple momentum with a 30-day moving average. So roughly a month and a half, we use business days. The second one captures more of a crossover momentum. So you see that big peak here is around 50, 60, 70 day. So roughly it's a 3 months momentum. So it's more like a medium-term momentum. But this one is smoothed because you have an offsetting weight on a very short 10-day moving average. So effectively, you can think about the second neuron as capturing 2-week versus 3 months moving average crossover. And the third neuron is basically dormant. You see in here on the outgoing weights, its weight is almost 0. It is 0. So basically it says we don't really need it. So we capture everything effectively with 2 neurons. And the third one's not really adding a whole lot. And then another interesting visualization, we can kind of plot the histogram of those Ds. Remember those Ds, and this is the weighted average of moving average. We can plot the values of this. Again, they're scaled, normalized. But the important sort of observation here, the first neuron, which is kind of in yellow here, sorry, some of the colors get kind of blended here, but you can see the first one captures more like a linear, monotone part of the reaction function. Most of the observations, most of the Z's are here. The second one in green, so it's more like spread out. So it's going and capturing this convex and concave part of the reaction function. That's when you trigger. So that's sort of a very interesting. In the paper, we also did exactly the same exercise for Brent, and we were very happy to find the results are conceptually quite similar, because from our perspective, that basically confirms the robustness of our algorithm. In other words, these CTAs are doing very similar thing in both WTI and Brent market by essentially identifying patterns using historical moving averages. And the final slide for today is like one of the really important applications of this analysis because it allows you to decompose effectively CTAs and other discretionary funds. Not all of the funds are created equal, as we described in Who is Who episode, the very first one. All type of hedge funds, CTAs, risk parity, discretionary, retail. Many of them are reported in managed money, except for retail. So, but what this algorithm does, it basically explains a portion of the funds that make their decision solely based on the historical prices. And then the residual would be other traders that make their decision based on other information. And that information, such decomposition is extremely valuable when you're trying to make a trading decision, because it's extremely valuable for hedgers, for policymakers. Is this market driven really by algorithms, or it's driven by human beings reacting to fundamental and macro information? In fact, what we are currently doing, and it's probably going to be in our one of the future videos, should expect part 2, where we are trying to look at the residual, which we cannot explain with the historical prices. And what we basically trying to do, we are modeling the residual by adding more features. So we're adding some fundamental features, we are adding some macro features. So I'm not gonna spoil and tell you the results, it's work in progress. But for today, I just wanted to introduce the whole concept that what hedge funds are really doing on aggregate is effectively the same or very similar to the mathematical definition of neural network. And we have provided you with some simple blueprint algorithm, which I hope you're going to take a look and make it better. And that's all I have to say for today. And thank you very much. If you like it, please subscribe to my channel, leave me feedback. I'll do my best to respond. And again, thank you very much for listening.